All right, so this problem focuses on transactions between a partnership and partner. We've got Cherry, Lemon, and Orange. They're three individuals. They form Fruit Loop LLC to create children's breakfast cereals. Under the operating agreement, Cherry is entitled to $10,000 each year for her services, which are ordinary in nature and performed in her capacity as a member owner. Cherry's share of the LLC profits and losses after deduction of the services payment is 1/3. The LLC's current year income before deduction of the $10,000 payment to Cherry consisted of $4,000 of ordinary income and $15,000 of long-term capital gain. So we have differences in characterization with respect to that amount. Cherry and the LLC use the calendar year as their taxable years. Cherry is a cash method taxpayer, and the LLC uses the accrual method. Determine LLC's taxable income for the current year and Cherry's distributive share. Okay. So we're told that Cherry is entitled to $10,000 each year for her services, which are ordinary in nature and performed in her capacity as a member owner. Now, there's three different ways that payment can occur to a partner. Either 707A, which is when a partner receives payment in their capacity outside the partnership. There's a 707C guaranteed payment, which is what we have here because it's performed in capacity as a member owner, but it's a guaranteed $10,000. And there's 704B, which is distributive share, which is not a guaranteed amount, but it is in accordance with the partner's actions inside the actual partnership. That's just the normal amount of allocated income, gain, loss, deduction, those items. So we've got a 707C guaranteed payment. How would you know? Well, the facts specifically tell us it's performed in her capacity as a member owner. If you were told in the problem that it was performed outside her capacity, like maybe you have a lawyer partner in a real estate partnership where they rent out real estate and the lawyer has to defend the business, the partnership against a tenant that brings a claim, and it's done outside the partnership because the lawyer owns a law firm, that would be an example of a 707A. But this is done in a capacity as a member owner, so that makes a big difference. All right. So, again, we're asked to determine the LLC's taxable income for the year and Cherry's distributive share. Now, we're told, let's go ahead and bring that over here. We're told the partnership, or specifically the LLC, right? It's taxed as a partnership for federal tax purposes. So it's really the LLC, but the partner, if I say partnership in this problem, I mean the LLC. We're told that the partnership has $10,000 payment to Cherry, and the LLC's current year income consisted of $4,000 of ordinary income and $15,000 of long-term capital gain. So as you know, in tax, character makes a big difference with a lot of different things, and we need to keep those separate. Anytime we have partnerships, remember they're flow-through entities. K1, you flow through those respective items to the owners. So in the big picture, right, we got $4,000 of ordinary income. So $4,000 of ordinary income, and we have $15,000 of long-term capital gain. Now, that's before considering this $10,000 payment to Cherry, because this is before deduction. So really, we have to subtract away $10,000 as an ordinary deduction because a guaranteed payment, right, that's what we have here, the 707C, guaranteed payment of $10,000. That amount is always going to be treated as ordinary in character. So that's going to give us a $6,000 ordinary loss. Ordinary loss by the partnership. The $15,000 long-term capital gain, that keeps its characterization the same. That $10,000 of ordinary deduction from the guaranteed payment does not affect that number. Okay? So under Section 703, which is where we determine the partnership taxable income, we are able to net these numbers. We're able to net the $15,000 and the $6,000 as a $9,000 partnership taxable income. We're able to net those two numbers together, but for purposes of Schedule K and the K1 to the owners, we break that up. We had to break up the $6,000 ordinary loss, the $15,000 long-term capital gain. Now, the question's asking specifically for LLC's taxable income, so we just did that. It's the $9,000. Again, for Schedule K purposes, it's broken up. So page 1 of the 1065, it's going to show a $9,000 taxable income at the bottom. And then on Schedule K of the 1065, it's going to have $6,000 of ordinary loss, $15,000 of long-term capital gain. So that's determining the LLC's taxable income for the current year. So we've done that. What about Cherry's distributive share? So what about just looking at Cherry? So if we're just looking at Cherry, Cherry has $10,000 of ordinary income, and that comes through on the Schedule K1 as a guaranteed payment. It's going to actually show that. Also, Cherry's going to have $2,000 of ordinary loss, and that's reported. That's the $6,000 of ordinary loss broken between cherry, lemon, and orange. And we're told in the problem that cherry's share is 1/3. I just assume that they all share 1/3 equally. That's why I meant there. So cherry's share is 1/3. 1/3 of 6,000 is of a $6,000 loss, a $2,000 ordinary loss. And then finally, we also have to break up the long-term capital gain, which that would be broken up between cherry, lemon, and orange. And cherry is a 1/3 owner, so that's also going to be 1/3, right? So it's $5,000 of long-term capital gain. And that concludes that part of the problem. Now we're told, assume that Cherry is to receive 1/3 of LLC profits regardless of character, but not less than $10,000. This is the minimum guarantee to be financed from Lemon and Orange's accounts. So that's guaranteed to come out of their share. Because the guarantee payment, that's the idea, is that regardless what the company does, you're guaranteed to get that amount of money. Determine the LLC's taxable income and Cherry's distributable share, same thing, if the LLC income for the current year consisted of 3 different situations. So now, let's go over here. We're applying similar concepts. We've got 3 different situations, so let's talk about those. We've got ordinary income of $15,000 and long-term capital gain of $15,000. So here, in this specific one, if we were to add these numbers together, right? We have ordinary income of $15,000 and long-term capital gain of $15,000. Remember, the partnership agreement we changed now says that Cherry's receive 1/3 of LLC profits regardless of character. That's key, is regardless of character there. But not less than the guaranteed $10,000. Okay? So regardless of character means, hey, we can add these together in determining the amount. Well, right there, if we add the 15 and 15, look at that. We get $30,000. Remember, we have to break that up. Well, Cherry's share is 1/3, and 1/3 is $10,000. So as long as Cherry gets $10,000 or more, it's fine. There's no issue. So in this situation, where there's ordinary income of $15,000 and long-term capital gain of $15,000, we're all good. Cherry's distributive share covers his or her minimum gain. Now, that's how we calculate that. Of course, for the Schedule K1 purposes, it's going to be broken $5,000 of ordinary income to Cherry and $5,000 of long-term capital gain. It still retains that character for purposes of the K1, but for purposes of this analysis of how we break it up for Cherry and make sure that Cherry gets his or her guaranteed $10,000, well, 1/3 of $30,000 total of what the partnership has done equals $10,000, so we're good. So in that situation, we are fine. Let's now go down and let's talk about what happens if the ordinary income, if all the partnership has is ordinary income of $15,000. So if we just take the ordinary income of $15,000 and we break that up, and remember, Cherry is to get 1/3. We don't know how the other partners split things, but since we're not told, we're going to assume that the other partners are also going to be 1/3 based on the facts, right? That's usually the rule, is that if something is silent, you assume the other owners they share equally. If you're not told at all, any of the owners are, you assume equally as well, because that's how it is under state law. So that's going to be $5,000. Well, we're told that Cherry's is not to receive anything less than $10,000. We have an issue now. So now we've got a problem, right? Before, hey, we had exactly $10,000, we were good. Now we don't have enough. Cherry is allocated distributive share, right? 704B, $5,000, right? That's what we did before as well. That's not enough. So what are we going to do here? We're going to reallocate this $15,000 because of this requirement that Cherry get at least $10,000. We're going to give $10,000 to Cherry. Yes, we're going to break it up. It says 1/3, 1/3, 1/3, right? We're going to give $10,000 to Cherry because, again, the guaranteed payment. And the remaining portion of $5,000 is going to be broken between lemon and orange. Lemon and orange, whatever's left over. So now you're looking at this and you said, okay, well, yeah, I understand that. That's what the agreement says. But here's where things get a little tricky. Because remember, when it comes to partnership tax, everything is about how you report it. The Schedule K-1. We saw earlier in the first part of the problem, right, we reported part of it as a guaranteed payment. So think about what's going on here. When we did this calculation above, we had the $5,000 of 704B. That still is the case. That ordinary income under 704B of $5,000 still is reflected on Cherry's K-1. The next $5,000 to get it up to $10,000. The next $5,000, what is that? That is a guaranteed payment. And if you look at, right now, if you want to stop the video, pause the video, look at a K-1, Form 1065 K-1, you will see there are different lines for ordinary income and guaranteed payments, even though guaranteed payments are considered ordinary income. Big reason why this makes a difference? Section 199A. There's other reasons why we had to separate it. So this is guaranteed payment, is the next $5,000, and that gets reported on a different line. So yes, even though they're both considered ordinary income to Cherry, there's differences. One difference, we have a chart where we have these different, we have 707A, 707C guaranteed payments, and 704B. One thing is the method of accounting. When it comes to the method of accounting, for 707A, we use the partner's method of accounting of when to report things, right, when the income's recorded. And then for 707C guaranteed payment, we use the partnership as well as 704B. So for that purpose, the partnership method of accounting is used for both guaranteed payments and 704B, just like we have here, right? This is 707C. So that makes a difference. But then for 199A purposes, there's a big difference there. And for 263 purposes, capitalization, because you don't have to capitalize for 704B, but you do have to capitalize potentially for 707C. And then for 199A purposes, for determining what's QBI, a guaranteed payment does not go in there. But the distributive share does, so it makes a big difference. Because the idea is that your taxpayer is going to get 20% deduction for qualified business income. So, hey, that's a $1,000 deduction on this $5,000. So if we were to say $10,000 of distributive share, like we had in the first part of the problem, right, up here, they get $1,000 more of deduction than they do down here. That makes a difference. Okay? So that's what it looks like to Cherry on Cherry's K-1. Now, what about, you might be wondering, what about with respect to orange or lemon and orange? So L and O. What about them? Well, they are going to report $2,500 each of ordinary income. Not guaranteed payment, just ordinary income. 704B distributive share. And the idea there is they have $5,000 of net income each, right? Because if we broke up the distributive share, remember it was 5,000, 5,000, 5,000, but then the additional next $5,000 that was a guaranteed payment to Cherry came out of their share as it says, as it specifically tells us in the problem, hey, it's financed from Lemon and Orange's accounts. Okay, last one we're going to do is what if Cherry gets $6,000? What if the partnership, my apologies, what if the partnership has $6,000 of ordinary income total? Well, again, we apply the same idea. This one's quick because it's a similar idea, right? 1/3, 1/3, 1/3. So Cherry's allocated $2,000. So on the K1 of Cherry, we've got ordinary income, 704B of $2,000. But remember that Cherry is supposed to get $8,000. $8,000 total. Some of you might be wondering, well, there's only $6,000 of income, so how could anybody ever be allocated more than the amount possible? We're told with respect to the actual partnership agreement that it's financed from Lemon and Orange's accounts. So think of it like a general partner that if the capital accounts go negative and they liquidate, they got to pay it back. Think of it the same way. So it makes a big difference. So the idea here is we're going to have an $8,000 guaranteed payment. So Cherry has guaranteed payment of $8,000 under 707C, so very similar situation before. Remember back to the 704B calculation, right? We've got Lemon and Orange as well. They also have $2,000 allocated to them, but now this $8,000 is broken between Lemon and Orange as a $4,000 deduction. So we have to bring that back up here. So they're each going to report a $2,000 ordinary loss. So with respect to Lemon and Orange on their K1, they're each going to report a $2,000 ordinary loss under 704B. Under 704B. And that's how we analyze that respective question. All right. So we got two more questions. And these are more kind of like procedural. When is the $10,000 included in Cherry's gross income if it's paid to her on January 3rd of next year? But we're told in the problem that the LLC uses the accrual method. Well, if Cherry did this work this year under the accrual method of accounting and accrual method for tax purposes, right? If it's been incurred, the expense has been incurred, then guess what? Under the accrual method for the partnership, they can take the deduction in the year they've actually incurred the work, incurred the expense, right? So we go back to our chart and the method of accounting for 707C purposes, we follow the partnership. That means that Cherry, we ignore Cherry's method of accounting. Cherry method of accounting, right, which is a cash method, which means it's reported next year, is ignored. And Cherry still has to include it this year. We'll call it year one, right? Year one versus year two. Right, January 3rd of next year, which is year two, and then the partnership or the actual work was done in year one. So that's all it does there. It makes a big difference. Now note, if this was a 707A payment, which again is when the partner is not in his or her capacity, which I probably won't have to tell you that, like if they're doing the work outside of their capacity as a partner, then it would be the partner's method of accounting, and then in this example, it would be in year two, is when Cherry would record it. And that makes a big difference, especially if you're in a different tax rate one year or the other, time value of money, all those different considerations. How does Cherry's entitlement to the $10,000 and payment of this sum affect the basis of her interest? So the guarantee payment does not directly affect the outside basis of Cherry or the capital account even. Obviously, we know the distributive share makes a big difference because that's your income, gain, loss deduction under 705. That authorizes an increase in basis for the partner's share of partnership taxable income. If the guarantee payment is deductible by the partnership, then it will not be part of any partner share of income. If it's capitalized, then it will be included in the partner share of income to some extent. It will not directly affect the outside basis of Cherry. So that's really, the idea is that for the most part, guarantee payments do not really affect the basis because they're kind of thinking them with some aspects, right? They're kind of like a hybrid. That's the idea here, is that this is basically a continuum. On one side of the continuum, we've got a 707A payment to a partner outside of his or her duty as a partner, right? So think of it like, the partnership is paying a contractor and they're getting an expense payment, independent contractor. On the other side, you have 704B, right, which is a distributive share, which we know, of course, that affects basis. Well, if you're being paid outside your partnership interests, that's completely outside the partnership. That's not going to affect your basis inside the partnership, right? That's completely, we call it an outside basis, but you're doing this outside the partnership, so it's like you're doing it separately. It doesn't go into your basis calculation at all right? 707C has elements where it's somewhere in the middle. I would say it's closer to 707A. It's not exactly in the middle, but it's somewhere in between this continuum of a 707A, again, payment when someone's outside his or her capacity as a partner, and 704B, distributive share. So that really goes through all those elements. Please revisit all those items. There's not many citations in this area. Again, I referenced some code sections, 707A, 707C, 704B, 263, 199A. They're just main code sections just to reference. This is more just about understanding what's going on economically, who's taking on things, and those types of elements. Again, please go back over it just to understand.